Good morning, everyone. My name is Sinead Fox-Hamilton. I'm a Relationship and Professional Development Manager here at Chartered Accountants Ireland, and it's my pleasure to be your host today and to welcome you to our session on investing, focusing in then on tax and also financial planning considerations. So this is a special 1-hour webinar kindly sponsored and delivered by Goodbody, and I'm delighted to see so many of you tune in. Now, before we get to the main presentation, I'll briefly touch on a few things. So agenda-wise, we have an expert speaker who will talk us through all the key content today. That'll take around 45 minutes. And then we have time at the end for Q&A, and we can field any queries that you might have. So if you would like to submit a question at any time during the presentation, you can do that by selecting the Q&A button on the menu and simply add your question. If you have any technical issues or anything else, use the chat function then to communicate with our team behind the scenes. So let's get things underway. As I mentioned, today's session is presented by Goodbody. So Goodbody is one of Ireland's leading financial services firms. The company has been serving clients and growing long-term relationships for nearly 150 years. They offer wealth management, asset management, and investment banking services to individual clients as well as businesses. So the company's wealth management division has a special focus on taxes. So in regard to inheritance planning, business exits, and bespoke strategies for customers around investments. And in recent years, Goodbody has seen an ever-growing number of tax questions, as a result of increasingly complicated rules around investment tax. So investors are thinking more holistically around their portfolios today. And Goodbody has seen that tax consequences are playing a really, really important role then in decision making. Our guest speaker today, Catriona Coady, is Head of Tax at Goodbody, and she works within the Wealth Management Division. She is responsible for assisting clients in developing and implementing their strategic financial planning, tax and investment goals. Prior to working for Goodbody, she spent over 20 years working with Big Four firms, providing tax advice to international and domestic clients. Catriona is a CTA, TEP, CFP and a STEP Ireland Committee member. She is a regular contributor to media on tax and financial planning related matters. And in January 22, she published the first edition of the Goodbody Investment Tax Guide, just to help streamline that fact-finding process around regularly asked tax questions about a variety of commonly used tax vehicles and investment vehicles. This document, it's available in print and digital copy. So if you would like a copy, do reach out after today's session. Now, I am going to stand in your way no more. I think that's enough for me, and I'm delighted now to pass across to Catriona. Catriona, over to you.
Thanks very much, Sinead, and good morning, everybody. I'm absolutely delighted to be with you today. And in this seminar, I wanted to set out, by way of case studies, a frequent set of client circumstances that we encounter where a blend of investment and tax considerations come together. And because of the frequency of the questions arising regarding the interaction of the two, this prompted us to produce the investment tax guide that Sinead mentioned. And that was really to summarize the tax rules relating to the type of investment instruments that a client, both personal and corporate, will likely encounter in an investment portfolio. Historically, while the starting point is always that tax shouldn't override the investment objective, and that is still the case, it has become increasingly important where tax reliefs are involved, and it's an area where some unintended tax consequences can arise. So in my first case study, I wanted to look at Simon and Sheila. So this is a frequent case that we would typically encounter. So Simon is Irish tax resident. He's ordinary tax resident and domiciled, and he's age 58. His wife Sheila is Irish tax resident, ordinarily resident, but UK domiciled and age 48. They have 3 children, Tom, Kathy and Max, age 18, 15 and 10. Simon and Sheila own 2 very successful trading companies, and a few years ago, for a number of reasons, a group was formed such that the shares in the trading companies are now 100% held by a holding company. Simon and Sheila own 100% of the holding company, owning 50% each. And over the last 2 years, both trading companies have been extremely successful and have generated significant amounts of surplus cash. Any surplus cash not required for the day-to-day operation of the trading companies is typically repatriated to the holding company. So in addition to their salaries and pension funding, dividends are occasionally drawn from the holding company. What's happened recently is that Simon has had an offer to acquire their businesses from a third party, and they feel the offer is just too good to refuse, and Simon and Sheila think it would allow them to retire early. Some other points about Simon and Sheila's financial affairs are that they have both funded pensions of 500,000 and 300,000 respectively, and that's through a combination of their own maximum employee pension contributions and employer pension funding when the company was in a position to do so. These are small self-administered pension funds, and they're invested in a mixture of equities, properties, bonds and cash. Simon also has a deferred defined contribution pension fund from a previous employment prior to his establishment of the trading companies, and this has a value of 300,000. Max, their youngest son, has recently received a compensation payment of 2 million for a personal injuries award. Simon and Sheila are anxious to invest it and safeguard that amount for his future. Simon is due to receive an inheritance from his mother of an investment portfolio worth in the region of 1.5 million. And he understands that this is made up of a mixture of equities and multi-asset funds. Simon has accumulated capital losses of 150k. And also just to say that Sheila has RSUs from a previous employment, which are now shares. So they've actually fully vested and they're now worth 200,000. Sheila also has capital losses, but that's on a UK investment portfolio. Simon and Sheila really like Portugal. They holiday there every year. And while not an immediate objective, they have thought about purchasing property in Portugal and relocating there in the future. Some other points that are relevant for the analysis is that annual living expenses are currently in the region of 200,000 per annum for Simon and Sheila, and they're due to increase for the next 4 years because Tom will attend university in the US. And for the purposes of this case study, I've assumed that they have no debt. So there are a number of issues for Simon and Sheila to address in respect of their asset base from an investment and tax perspective. So just to look at their asset and income summary for 2022, I've already touched on some of this, but just to say their main residence is 1.5 million. They've 3 rental properties, which generate gross rents of 54,000 a year. They've got their Irish investment portfolio generating an income of 20,000 a year. Sheila has a UK investment portfolio worth 1 million, and she gets a dividend of 20,000 on that a year also. Her shares are worth 200,000 and she gets a dividend of 4,000 on that. They've got a deposit account of 150,000, and the estimated value of the trading companies and the holding company investments is in the region of 7 million. They're drawing salaries of 200k each from the company, and they also then have their pension assets. One other very valuable asset they have is their convertible term life cover, which is 1 million. And then Simon made an EWIS investment of 50,000 a few years ago, and there will be a return on that. He's expecting a CGT return, but is unsure whether or not that will be the outcome. So when you look at that, their total income is 478,000 when you exclude the UK dividend for reasons that I'll explain later on, and their entire asset base comes to approximately 13.9 million. So for the purposes of the case study, I've assumed that capital growth on rental properties is 3% with 2% growth on rental income. Cash isn't growing at all. Their Irish investment portfolio grows at 5%, 3% growth and 2% income net of fees. Sheila's vested shares grow at 2% with a 2% dividend per annum. Pensions are growing at 4% net of fees. As I mentioned, EWIS is dependent on the outcome, and inflation is at 2%, that being the long-term inflation rate when we take into account a 50-year time horizon. So what are the issues to address for Simon and Sheila? Well, I've broken these down really into 8 issues. So the first one being their attitude to risk and their asset allocation, the sale of the trading companies to a third party and investment of the proceeds from the sale, their existing Irish investment portfolio, Sheila's domicile and her UK portfolio, their pension funds, the compensation that Max is due to receive, the convertible life insurance policy, and Simon's potential inheritance. So from an investment perspective, their attitude to risk will be measured using a risk assessment tool, and clients very rarely review their asset allocation to determine if it matches their attitude to risk. So in Simon and Sheila's case, the risk scores indicate that they've got a low risk appetite. Yet when you do their asset allocation as broken out in the table there, 89% of their assets are in high risk assets, being equities and property. And in this situation, it's worth revisiting the risk assessment score to establish the motive behind investing heavily in equities and property. The company shares are not necessarily traditionally equity risk as you would find in an investment portfolio, but even without them, the predominant proportion of their assets is in equities and property, being high risk assets. So the question is this a hedge against inflation? Is the view that property is a safe asset, or is there a longer term objective in relation to their income requirements in retirement? And do they realize that their asset allocation is effectively out of sync with their risk appetite? That just summarizes there exactly the points that I've made when you look back at how their asset allocation is broken down. So the tax structuring that Simon and Sheila undertook a few years back means that on a disposal of the shares in the 2 trading companies by the holding company, the proceeds received will flow up to the holding company tax-free. So that means that in addition to existing investments worth 3 million that are already in the holding company, a further 5 million in cash will be received by the holding company. And that's a great outcome in terms of tax efficiency for the corporate. But there are a few issues that Simon and Sheila didn't realize in relation to this event. So they always wanted to keep the holding company in place and use it to invest surplus cash and the funds received from the sale of the business. And they're looking for a portfolio, an investment portfolio for the corporate that they can control, because they view the holding company as being the vehicle for the next generation, and they intend to introduce the children to it by way of shares in the future. So they think they will have enough income to meet their annual living expense requirements from now until age 100 from their rental income, existing investment portfolios, and their pension funds, which they will access at age 65. However, when this cash flow analysis is modelled without any draw from the corporate, their liquid assets will deplete at age 63 and fully deplete at age 71. It now becomes clear to Simon and Sheila that they'll need to draw funds from the corporate to meet their annual living expenses. However, post the sale of the trading business, they didn't realise that if they retain the holding company, if they need to extract funds from it, this would be at income tax rates. They were also mistaken in thinking that they could avail of CGT entrepreneur relief and or possibly retirement relief, and that's become a huge disappointment to them. So very often we find with these structures, clients have an idea around entrepreneur relief and retirement relief, but they're not entirely sure how they will interact when there is a sale of trading companies and a holding company is involved. So following the sale of the businesses, the holding company has effectively converted to an investment company, one that is housing an investment portfolio plus the surplus cash from the sale of their businesses. This just illustrates the point in relation to the depletion of their income effectively if they don't take any draw from the corporate. So their salaries have ceased, they've taken the offer to purchase the trading companies, and they didn't want to draw from the holding company. So they've used up all their personal investments. Then they've decided to draw their pension funds at age 65. And you can see there at age 63, red in the charts signals a shortfall in income to meet annual living expenses. Things improve for a little while after they draw their pension funds, but then they go back into shortfall at age 71. The other point about the sale is they hadn't realised that income and gains within the corporate will be taxed, and then, as mentioned earlier, a second charge to income tax will arise on the funds they extract personally to meet the shortfall in annual living expenses. So this has left them wondering if they would be better to liquidate the holding company and grow the money in their personal names, as they could liquidate the holding company at CGT rates. Sometimes when that analysis is run, the outcome is that it's better to retain the funds actually in the holding company and to grow them in the holding company. I would say that's just to be determined, though, on a case-by-case basis. So just if they were to liquidate, net proceeds of 5 million after 33% CGT would come out into their personal name versus 7 million if it were to stay in the holding company. Just a little bit of analysis is usually required there, just based on their personal circumstances, to see what is the right thing to do. So it's important for them to realise that the corporate is only really acting as a tax deferral mechanism, and their need for income should also shape how the corporate monies are invested. So that leads on to the next question: is how will the money in the corporate be invested? Well, given their need for income, this would typically involve a liquidity pool made up of, for example, the highest rated government debt with staggered maturity or liquidity points. And there'll be an element of tax efficiency to this, because this will usually be something like a German government bond. The remaining portfolio will then be used for a higher return investment strategy. And what this allows the corporate effectively to do, or this particular structure, allows longer term investments to grow and compound without the need to liquidate in times of market stress. So from a tax perspective, in a well-diversified portfolio like this, there'll be a blend of equities, there'll be fund investments, there'll be bonds, bond funds, there'll even be life-wrapped investments, and they may be Irish instruments, foreign instruments. So there will be quite a full range of investments typically within the portfolio. And this is where the tax treatment of these specific investments comes into play, particularly on the funds front. And while the issue of while the issue of tax, I'd say, is less in the case of the corporate in the context of tax rates of 25% and CGT at 33% versus individual rates, the other point to bear in mind is the closed company surcharge. So while Simon and Sheila have an income need, this may not arise, but it will need to be monitored, because that will effectively push the effective tax rate in the corporate up to 40%. And there will also be then the income tax charge at some stage on the extraction of the funds from the corporate. So if closed company surcharge is likely to be an issue, there is a little bit of work that can be done on the portfolio to manage this. So for example, capital growth instruments can be selected where there'll be no or minimal income being paid on those instruments. Capital gains not being subject to the surcharge, so that's the benefit of that there. Accumulating rather than distributing lines of funds could be selected, such that when the 8th year deemed encashment charge arises, this coincides with the distribution to the shareholders. However, this would need to be monitored, because the impacting of compounding without tax over 8 years can yield quite a generous outcome from an investment perspective. So the strategy, in other words, of maybe extracting in 8 years' time when this event is about to come around would need to be monitored, just to make sure that's done, so that there isn't the surcharge on that very generous investment growth. The life wrapped route is also sometimes chosen for an element of the portfolio, the view being that income and gains on a life wrap policy are not subject to the surcharge. So that's effectively an investment portfolio with the life company wrapper around it. So one of their objectives in the future may be to purchase a property in Portugal, and where clients' affairs are structured in a similar manner to Simon and Sheila, the question often arises as to whether it's better to purchase property in their own personal names or in the corporate vehicle. And that can simply just come down to whether or not there is enough personal money outside of the corporate to purchase the property. If there isn't, then the corporate will purchase the property. There's issues to be considered there in the context of the benefit in kind charge or distribution issues for the use of the company, because this is a closed company. And then the tax costs associated with the ultimate extraction of the property from the corporate. Sometimes a separate company is formed so that it's the shares in that company that are ultimately sold and not the property itself. One other point to mention is that the tax implications of such a purchase also needs to be considered in the jurisdiction in which the property is actually located. So then what would happen if they relocated overseas? So one of the reasons that the holding company was put in place was to give Simon and Sheila the flexibility of relocating overseas and disposing of their shares in the company when they were no longer within the charge to Irish tax. And that's a structure that, or an objective that we would quite often see. And clients may have some awareness, but not a full awareness of the time frame that is involved in being able to extract the funds from the company tax efficiently following a relocation overseas. So under Section 29A, which is the temporary non-residence rules for CGT purposes, an absence of less than 6 years between the year in which the taxpayer leaves Ireland and the year of return would trigger a CGT charge in Ireland. This is a rule that wouldn't apply to Sheila because she's not Irish domiciled. It's just one thing to be particularly mindful of where the value of the shares is over $500,000. And then sometimes what we tend to find is when faced with the prospect of spending 6 years out of Ireland, when it comes closer to a decision to migrate overseas, some clients do not wish to pursue this option for a variety of personal reasons. And that really puts paid to the whole idea of relocating overseas. If there is a strong possibility of a relocation overseas, or the client has already moved but is not fully outside of the Irish tax system, consideration can be given to establishing the corporate investment portfolio with a view to moving it in specie to personal ownership. And from an investment perspective, particularly if there's, if the investment portfolio has only started, it can result in some tax savings if the portfolio can migrate in specie without disrupting the investment mandate through disposals and reinvestments. Again, an understanding of the tax treatment that will apply in the other jurisdiction on the investment portfolio is important in these circumstances. And again, I suppose with the best will in the world to assist with both the tax and investment objective of the client, it's not always possible to achieve the perfect answer here. So moving on to the assets that they hold outside of the corporate, their Irish investment portfolio generates an income of 2% per annum, but on closer examination of it, it's an investment portfolio with a life company. So what that means is that the gains and income are subject to 41% exit tax, and there's a deemed encashment of the portfolio every 8 years. Simon and Sheila thought that their capital losses could be offset against income and gains on the investment portfolio, but they can't. Even if this was an investment portfolio with CGT instruments, Sheila's losses on her UK portfolio could not be utilised because she's taxed on a remittance basis. And I'll come into that in a little bit more detail later on. So one other objective is that Simon and Sheila would like to look to migrate that portfolio to a direct unwrapped portfolio, which doesn't have that life wrapper around it. But while the fund has historical overall growth of 5% per annum, it has done better again over the course of the last year, meaning that a sizable tax liability will arise on its full disposal. So they think it would be better to wait until the 8th year event and dispose of it fully on that occasion, because that charge is actually going to arise then anyway. But the message, I suppose, here, it really depends on whether or not they've already depleted this investment portfolio in order to meet their annual living expenses, as illustrated earlier on. So in relation to Sheila's domicile and her UK portfolio, this has been created purely with tax efficiency in mind. So Sheila's UK domicile allows her to avail of the remittance basis of taxation here. It's denominated in euro because foreign currency, being an asset for capital gains tax, would be an Irish located asset for CGT purposes. It doesn't contain any assets that would be considered Irish situate for CGT purposes, or offshore funds, which would be subject to the 41% tax rate. So they're the good offshore funds, which are effectively treated like an Irish asset where a remittance basis taxpayer is involved. So where there are portfolios, though, in place for non-domiciled clients, it's always important to remember that it may not be possible to construct the portfolio to completely contain non-Irish situate assets, because again, back to the whole risk appetite and asset allocation, there may be some investments that need to be in there that where the investment objective overrides the tax requirements of the portfolio. But if you can achieve that particular outcome, in other words, a portfolio which does the two, which actually meets the tax efficiency piece and also the investment objective, it's just important to bear in mind that it can be a little bit more restrictive over time. The client will need to be aware that this type of portfolio is just purely generated for tax efficiency from day one, which can override the investment objective, so investment returns may be compromised. If the income or gains are not being remitted to Ireland, particularly on the income front, there will be some unrecoverable withholding taxes, so there'll be no ability to claim a credit for those withholding taxes if the money actually isn't being remitted to Ireland. One other point that's relevant in the context of Sheila is that her worldwide assets are subject to UK inheritance tax because of her UK domicile, and because Simon is actually Irish domiciled, there's no blanket spousal exemption like there is here from one spouse to the other should he inherit from her. So there is a mechanism for actually electing for UK domicile for him, but he's unlikely to want to do that. On their pension funds, you may all be familiar with the fact that investment income and gains on their pension funds grow tax-free, gross roll-up, but where there's an investment in foreign equities, some unrecoverable withholding taxes again will arise. And given the current tax favourable status of pension contributions for both employees and the employer, gross roll-up, the 200k tax-free lump sum available on retiring, if more can be done to fund a pension up to the current maximum tax efficient limit of 2.15 million, this should be done. Sometimes clients who have their eye on a relocation in a couple of years' time might actually look to migrate their pension overseas. And that might be a better solution, particularly because the ARF, the Approved Retirement Fund, or annuity route here may not be the most compatible with their tax resident status at the time that they choose to access their pension funds. One of the reasons for that being that you can't get a PAYE exclusion order on an ARF from the Irish Revenue, because their view is that an ARF is not a pension fund per se for this purpose. And the method of claiming credit for taxes on an ARF is quite complex. So the decision in that situation might be to actually migrate the pension fund overseas before it's actually accessed. One point to bear in mind in relation to that is that the underlying investments of the pension can still be managed in Ireland. So even though the pension funds may be gone to Malta, the underlying investments can actually be managed here, and that might give some peace of mind in the context of regulation and what exactly is being invested in. If circumstances were to change, the pension fund could be repatriated to Ireland and the ARF option exercised. Again, the tax rules in the country of tax residence would need to be understood, and the place of the location of the pension fund will also need to be, the tax rules there will also need to be understood so that no unforeseen taxes arise, for example, on death. So some situations that we would see would be that the pension fund actually goes to Malta, but the clients themselves relocate to Portugal. The benefit of Malta being that there's no 2.15 million cap on the pension fund. The lump sum is at 30%, and again, there's no limit on the amount that's tax-free, and the pension can be accessed at age 50. On Max's compensation payment, this is one that qualifies for the exemptions on investment income and gains under Section 189 of the TCA 1997. Generally, from an investment perspective, the funds will be invested conservatively such that the fund will not be put at risk. And also from a tax perspective, the aggregate income and gains from the investment of the compensation proceeds must exceed 50% of the total aggregate income and capital gains of the individual in the tax year, and certain social welfare benefits are actually excluded in determining whether that test has been met. So where the 50% condition is satisfied, investment income and gains are exempt from income tax, CGT, and where there's Irish funds, for example, on which exit tax has been withheld at source, an exemption will also apply there. What sometimes happens in a situation like this is that a controlled approach may be required. So where, for example, there's other income that's actually taxable within the year, an accumulating fund could be used such that there's no investment income or gains being generated, and that then doesn't put the 50% test at risk. So the other income is taxable, but you haven't had to concern yourself with the 50% test because there's no investment income being generated by that accumulating fund. So the convertible life insurance policy, I mentioned this earlier as being a very valuable asset, and clients are often astonished when they realise that the value of their entire estate and the CAT liability that their children will face. So if you were to look at the 13.9 million that Sheila and Simon have actually generated in assets, their CAT liability, the children's CAT liability, would be in the region of 4.5 million, or approximately 1.1 million each. So that can come as a huge surprise when parents and children actually reflect on it. Any existing life cover should always be reviewed to determine whether it can be converted to a Section 72 policy, such that it can be used to shelter some of the liability, some of the inheritance tax liability arising for the children. And the benefit of a convertible life insurance policy is that it could potentially be useful in that it could be converted to a Section 72 policy without the need for clients to undergo a medical. So those Section 72 policies are valuable in the context of being able to meet some of the CA inheritance tax liability for the children without being considered a taxable inheritance in themselves. So in Simon's case, he's due to inherit a portfolio of 1.5 million from his mother, and this comprises of shares, direct equities and funds. The direct equities will rebase to market value on death and will not give rise to a CGT charge for Simon, whereas a 41% tax charge will arise on the funds. The exit tax can be offset against CAT arising where Simon holds the investments for 2 years from the date of inheritance. For Irish funds in the portfolio, the offset is confined to inheritance tax, but where it's foreign funds, the offset is actually available on a gift or inheritance. None of us are really quite sure why there's a difference there in being able to offset gift and inheritance tax under the offset rule for a foreign fund, but only Irish inheritance tax in the case of an Irish, only inheritance tax in the case of an Irish fund. So there's still much more to talk to Simon and Sheila about, and you know, there can be many variations on the situation that I've just outlined, but some of the issues to continue to talk to them about would be CAT, being gift and inheritance, the gift and inheritance tax exposure for their children, Sheila's domicile, and the fact that there is a worldwide, her worldwide assets will be subject to UK inheritance tax, their overall estate plan, so what it is that they intend to actually do, and an ongoing review of their investments and the variations on the type of investments that might be housed in their different portfolios. From a pensions perspective, the recent IORPS 2 regulation and whether they need to make any adjustment to the actual blend of investments that are in their pension funds as well. I would also ask them to watch the 8th year deemed encashment charges, because for Irish funds that are held, for example, in a recognised clearing system, exit tax is not being deducted at source, and brokers are not necessarily tracking that 8th year deemed encashment charge. So just to keep an eye on that. The other piece is to be mindful of their changing financial goals and objectives, and to check in every so often if there is some change that they have undertaken or want to undertake, and then to you know, redesign or redevelop their plan with that in mind. And this usually involves a multi-advisor approach, and by that I mean there will be financial advisors involved, there will be tax consultants involved, and there will also be solicitors involved, for example, particularly around the will drafting piece or powers of attorney, enduring powers of attorney. So if I go on to case study 2, I just wanted to extend the situation to some topical questions that are arising. So in Simon's case, his mother's portfolio actually contains some US equities and US ETFs. And where there are non-US citizens involved, there's a $60,000 limit for US estate taxes, and any amount above that is actually subject to estate tax at 40%. So if, for example, the value of Simon's mother's portfolio contains US equities worth $500,000, then that will be exposed. They will be exposed to US estate tax at a rate of 40%. This particularly becomes an issue where, if, for example, it was a spousal situation, so there's no exemption under US tax rules for the transfer of these US shares from one spouse to another. And therefore, the element of US equities and US ETFs that are in the portfolio are exposed to that estate tax of 40%. So what the solution there is typically to redirect those shares to someone who's within the CAT charge. So at least there can be some offset for the US estate tax against the Irish CAT under the estate tax treaty between Ireland and the US. One thing to bear in mind is that historically over the last while, US equities have outperformed every other type of asset effectively. And again, what you're doing is you're skewing the investment objective. So if you're trying to work your way through this particular issue, just be mindful of the fact that you're probably going to take an investment hit. So this is back to the point where you're not wanting to jeopardize the investment return in lieu of a tax efficiency. So just to bear that particular point in mind. Some solutions that are some structures that clients may have put in place might be that they would hold the US equities and ETFs in a non-US corporate or in a non-US partnership, such that what's passing on death is the actual shares or interest in the partnership and not the underlying US equities. The second topical issue is around US ETFs. So some of you may be familiar with the revenue e-brief, which issued last September and led to some confusion. Prior to that, the revenue had said, you know, that there was this blanket position in relation to US ETFs, whereby they were taxed under general tax principles, so income tax and CGT, and the whole issue of whether it was an offshore fund didn't come into play. But they removed that blanket exemption effectively by issuing the e-brief in September 2021, which led to some confusion because clients then thought all of their US ETFs now actually felt to be taxed under the 41% offshore fund regime. But that wasn't the case. There was no change in revenue position as such. But it doesn't mean that all US ETFs are now subject to funds tax. But what it does mean is that there's a level of analysis to be done to make sure that your US ETF isn't subject to funds tax. So what they want you to do is they'll actually look at the analysis that's done to determine whether an investment is subject to funds tax or is taxable under normal taxation principles, being income tax and CGT. So that's not a great outcome, I suppose, in the context of simplicity for investors or intermediaries. I think what was beneficial before was that when you selected an instrument, you could just say, okay, well, we have certainty around the tax treatment of that US ETF, whereas that's no longer the case. But very generally or broadly, there are some differentiating factors that make an ETF more likely to fall within the CGT and income tax regime, such as the way in which the shares are traded and the regulation surrounding those. But as I say, a level of analysis needs to be done. So when the revenue issued this e-brief, then there were some concerns that what would I do with my historical capital losses, because I'd no longer be able to avail of those, and when would the 8th year deemed encashment charge apply from? And in February, Revenue issued a revised e-brief saying that with effect from 1 January 2022 is when you'd start to count the 8 years for the deemed encashment charge. So 2020 would be the earliest deemed disposal date. So that at least gave some clarity on that front. You're probably wondering why invest in US ETFs. Well, again, it's back to the point that US ETF give you an exposure to tech companies that are predominantly US based, and they've been performing very well effectively. So that's the reason why you would typically have a client, it being suggested to a client that US ETFs would be part of their investment portfolio. So that's it from me, unless I think we're going to hand over to questions now.
Brilliant, Catriona. Thank you so much for sharing all of that. Lots of expert insights, and there's certainly been a lot of ground covered, so it's not surprising that we do have some questions coming in. So we'll do our best to get through a few. So if I take the first one there, Catriona, you mentioned that there could be variations on case study one from a client perspective. Can you maybe give just a few more examples of those variations?
Sure. So like we've seen various different types of corporate structures put in place whereby there might be a shareholding that's held directly in the trading companies by the shareholder, and that's for the benefit of actually claiming entrepreneur relief. So getting some element of the proceeds on the disposal of the trading companies out free of tax, or certainly at the 10% rate, sorry, apologies. So the entrepreneur relief would actually allow you to take 1 million of the gain at 10% with the balance at 33%. So there's some variations on the structuring that can actually be done. There would also be some early structuring done, maybe really in relation to introducing the children to the business by way of shares, and maybe providing them with a growth share, for example, where any future growth in the value of that share grows free of CAT.
Great, thanks for that, Catriona. And another one here as well to put to you. Why are funds a major feature in client portfolios now rather than direct equities?
Um, so it's again back to the diversification point. So really to get you the exposure to a range of instruments, and really to manage risk, again, funds have become very topical in portfolios. So that's why you will see them as a large component of portfolios. So typically I know for tax return preparers, they might be looking at some of the portfolio statements that come out for clients and wondering why there's so many different fund investments, but generally it's to have a very well diversified portfolio.
Sure, great, thank you. And another one here for you, Catriona. Are personal holding companies a legitimate way to defer tax and dividends, say for a number of years prior to moving residents to Portugal?
Yeah, again, they are to an extent, but I mean, there's a bit to do to take yourself out of the Irish tax system. And that's traditionally why those holding companies may have been put in place. They offered an element of flexibility. So, but as I say, that can be a 6-year journey for a client. And there could be other issues involved in actually tie breaking yourself to the other country under the relevant double tax agreement. So a lot for a client to actually consider in that situation, and to be aware of, because as I said, for a variety of personal reasons, by the time the client is considering the move, they think, actually, you know what, the kids are in secondary school, they're well settled. I'm not sure that we really want to make that move to Portugal, for example.
And if I can ask then also, is Portugal the best option, assuming Simon doesn't want to be stuck on a small island like Malta?
So Portugal does have a very favourable tax regime, and we do tend to find it comes down to personal choice. So if you don't like Malta, there's no point in actually making the tax rules might be great, but there's no point actually making that your home if you just don't want to be there. So the non-habitual residence regime in Portugal is quite favourable. So it can be anywhere. It doesn't necessarily have to be Malta or Portugal. Clients will look to move to France, but generally the tax regime in the other country does play a large feature in which country the client chooses to relocate to.
Of course. And another, I suppose, question around this: if Simon moves to Portugal and sends his pension to Malta, is the pension, pardon me, liquidated tax free? So does the 6-year rule apply to the pension? You know, it would be taxed if Simon comes back then within scope of Irish authority.
No. So when the pension moves, it would be measured against the 2 million tax-free threshold at that point in time, in which there would be no tax. So when it's actually sitting out in Malta, for example, and the client is actually sitting out then in Portugal, there's no actual tax charge at that. You know, there is the tax considerations in Malta and in Portugal, but not in Ireland. But if the pension were to be brought back, you would need to look at how the revenue would view that in the context of a benefit crystallization event, meaning the 2 million threshold. But when it comes back, you're probably going to exercise the ARF option anyway, because you're back fully within the Irish tax regime, and the ARF option is probably a better structure to have in place for you then in respect of your pension fund. But that 6-year rule in the context of the temporary non-residence rules for CGT purposes doesn't apply to the pension.
Okay, great. Thank you for that. I have a question in, Catriona. Can you talk a little bit more through the analysis when considering if US ETFs can fall outside the offshore fund regime?
So actually within the guide, we go through, you know, the various different steps that you would need to take to analyze whether or not the fund that you're looking at falls within the offshore fund rules. So there's a bit involved in actually determining whether or not you're able to realize the investment within 7 years, of investing in it. What type of investment vehicle is it? And is it similar in all material respects to the equivalent of that Irish investment vehicle? So if it's equivalent to an Irish unit trust, for example, an Irish investment company. So you're looking at that fund and trying to determine, is it similar in all material respects to one of those entities, or a form of a collective which gives rights in the nature of co-ownership. So it's quite a detailed review that actually needs to be done. And then if your analysis falls to suggest that actually, yeah, okay, I do have a material interest in the fund because I can realize its value within 7 years. And actually it's not similar in all material respects to an Irish unit trust, and it's not regulated in a particular way, then the likelihood is and also in ways in which the ETF is traded, it's traded similar to a share, that can also lend weight to the argument that it's actually subject to tax under general principles, as opposed to the 41% offshore fund regime. But there's a bit of work to do to get there, and I think that's what, you know, raised a lot of concern around the time of the revenues e-brief, because all the tax advisors figured out that they would actually have to go off and do a level of analysis to determine whether or not any ETFs that clients were invested in actually fell within the offshore fund rules.
And you mentioned the guide there, Catriona. What's the best way to access that? Would you like us to share that in the follow-up, where we will provide a copy of this recording and the slides, or is there a contact email for folks to reach out to you?
Yeah, so there is we can arrange both. So I'll follow up. You can certainly send it with the follow-up materials from this, or there is an actual form on our website where that you can fill out to get a copy of the guide.
Great, so very accessible. Super. I just wanted to check that because I know there was a couple of questions. Brilliant. I do have a couple more questions. We'll do our best to get through those. Catriona, some Irish funds don't have exit tax withheld at source. Can you explain the reason for that?
Yes, so this is one that can sometimes cause a little bit of confusion, and that's where the fund has been moved to a recognized clearing system. So the fund is saying, we're not going to operate the exit tax at source or do any of that. But what that means is that the investor themselves then actually has to declare the income or gains in respect of that investment on their personal tax return. So that's just one to be mindful of. And they've also got to track that 8th year deemed encashment charge that would arise on the fund. So we produce with our annual tax pack a fund sheet, which gives you an indication of whether or not the fund is actually withholding tax at source or not, so that at least the taxpayer then knows that they've actually got to include the information on their tax return where it hasn't been withheld at source.
And very lastly, I think we have time for one more. What is the difference, Catriona, between an accumulating and a distributing fund?
So again, we would see this in the context of maybe clients who don't have a need for income. So they're allowing the investment to effectively roll up. Again, you'll have an 8th year charge, and that would be an accumulating line of a fund. Now you can switch to a distributing line of a fund, and that will actually pay you out income. So again, I suppose standing in the shoes of tax advisors who might be wondering, why is there an accumulating line on which there's no income? The reason is that that's what it's doing. It's just accumulating all the returns, and there's no tax charge until that 8th year event. Whereas the distributing line, there will be tax at 41% on any income generated on it.
Super. Catriona, that is it in terms of the questions, and that's a wrap then, folks, in terms of today's event. Thank you again to Goodbody for sponsoring and delivering today's session, and obviously to yourself, Catriona, for sharing your expertise and insights. Hugely valuable session for our members, and we really appreciate your partnership today. And thanks also to those involved behind the scenes, including our own Chris Donoghue from the Institute team. He is in the wings looking after all the tech. And thank you all for joining us. I hope you enjoyed the session and got a lot from it. And I do hope we can continue to welcome you to future Institute events. In that vein, I'll just briefly mention that our full programme of CPD activity is available online on our website, should you wish to explore other training, other events. I know as we move through the year, everyone is keen to get in those all important CPD hours. So our programme is very much live and there's a full range of offerings, folks. If you have any queries, any follow-up, any feedback, indeed, in related to any CPD matters, reach out to us at cpd@charteredaccountants.ie. We will follow up, folks, with recording and materials after today's session. And that is all from us today. Thank you again, everyone. Have a great rest of the day. Take care and bye for now.
Thank you.